What is up everyone, my name is Julian and welcome to the Financial Dose. Today we will be talking about credit scores. So in short, what your credit score is, it's a score that different institutions can use to determine the likelihood that you're actually going to be paying your bills on time. And this is important when it comes to maybe applying for a new cell phone plan, if you're starting out, applying for a credit card obviously, applying for a loan at a bank, applying for a mortgage, and stuff like that. So if you have a high credit score, odds are you'll get the debt instrument that you're applying for, or you'll get a favorable rate on that instrument that you're applying for. So the most popular score is the FICO score. And this score classifies you from 300, which is the lowest, to 850, which is the highest. So just briefly for the breakdowns, which I'll show you guys on the screen, from 740 to 850 is excellent credit score. From 680 all the way up to 740 is good. And then we work our way down the scale all the way to the $300 to $500 range, or not $500, $550 range, which is poor. And even though the FICO score is the most popular score, there is a downside to this, is that there's no room for discretion. So if you're applying for a loan or a credit card or a mortgage and the cutoff rate is 680 and you're at 667 or 675, you will not get the product because there's no flexibility given to you in that aspect. Later on in the video, we'll talk about other organizations that also have a credit score and a kind of equivalent to the FICO score, but that also offer a credit report showing all of your detailed debt instruments and showing all of, let's say, your past issues that you've had with these debt instruments. So if you missed a payment, 3 years ago, it'll show up in your credit report and it'll usually show the amount of the payment that you missed. So these sort of credit reports are much more comprehensive. So if your FICO score is on the limit of being accepted, maybe it'll be better for you to go look at other financial institutions that put more weight on the other scores and that actually take into account your credit report. So this could be very important or very helpful to you if, let's say, you're 10 points below the minimum FICO score and you won't be able to get the product with this bank. Maybe if you go to another bank that will take into account your whole credit report, it'll make it much easier or much more plausible for you to get that credit product that you're trying to get. But before we get to outlining those different services that offer those reports, let's talk about what composes your credit score, or in this case, the FICO score. All scores are fairly similar as into the weights that they put on each category, but we'll start with the FICO score. So before going on to the other services that offer the full credit report, we're going to talk about what is the breakdown or what composes the FICO score. So essentially there are different categories and they put certain weights to each category, illustrating the importance of that category. So let's briefly walk through them. So first off, your payment history, which counts for 35% of the FICO score. Now, what this means is it just shows, or it just sort of calculates or evaluates if you pay your bills on time. Now, some people may say, yeah, obviously it's important to pay your bills on time, and some people believe in paying, let's say their credit card bill in full. But this score, what it looks at is it just looks that you make the minimum payment. So if you have a $1,000 balance on your credit card and your minimum payment is $10 and you make it, no problem, you're good. It will not affect your credit score. Yes, you will be charged interest on the balance, but your credit score will remain intact. If you pay the balance in full, it doesn't give you an advantage. It just shows that you're responsible with your credit and you pay it on time. If you miss a payment, let's say you miss 1 month's payment and then you paid in full the following month saying, hey, it's not a big deal, I just missed 1 month, and the following month I paid it off in full. Well, even though you do pay it off, it does affect your credit score because you missed a payment. So it's very important not to assume that, okay, well, I pay my credit card balance off every 2 or 3 months and I don't pay it off, or I don't pay anything in between. Just assuming that that's okay because it's paid off every 2 or 3 months, like, oh my God, what's the big deal? It's just 2 or 3 months. But for them, if it's late, it affects your score. Even 1 day late or 3 days late or 5 days late, it doesn't make such a difference on your FICO score because they don't note how late the payment is. They just say, oh, it's late, so it will negatively impact your score. The next thing is how much you owe, or your utilization rate. So let's say you have, a $10,000 credit card here and you have a $5,000 line of credit. If your credit card's at $5,000, it means you're using 50% of your credit card. If your line of credit is at $9,000, no, sorry, I said 5,000. So if your line of credit is at $4,000 out of 5,000, it means you're using 80% of your line of credit. And the importance here is to try to be below a certain ratio. So depending on where you look, some may say 30%, some may say 75%. Obviously, it's a huge, gap between the two, but you don't really want to be above 75% of utilization. So if you have, $50,000 of consumer debt available to you, try not to use more than 75% of that. If you do have to use more than 75%, it's not a big deal, but it will affect your credit score. And the reason why is that the bank sees it as, oh, well, this person is more at risk of being late on a payment because they are using a lot of debt. And even though you may say, well, okay, if one person has $100,000 available to them and the other person has $10,000 available to them, well, it's kind of unfair because the one who has $100,000 can use, $50,000 and still be way below the 75% threshold. But the person who has $10,000, well, they can't use $50,000. They can only use $7,500 until they reach that threshold. Well, yeah, the credit score isn't perfect, and the sort of logic behind that is, well, if you were able to get $100,000 of debt, you must be better standing or have a better standing in terms of credit compared to the person that could only get $10,000. So in a sense that evens out, but yes, I agree, it is somewhat unfair if you just look at the utilization rate. That's why it's only sitting at 30%. The next metric that they look at is history. So this counts for 15%, and what this essentially looks at is how long you've had these credit instruments. So let's say as soon as you turned 18, you got a credit card like you should to start building up that credit score, and then you decided to cancel that card at 22 because you got a much better card. Well, that would be a bad thing to do because then you just canceled 4 years of credit history. And if you don't have a mortgage, if you don't have a line of credit, if you don't have any other debt instrument, then your sort of credit score kind of, not that it gets reset, but your history sort of gets reset all the way up to this new card. So ideally what you'd want to do is, yes, if you're able to get a better card because you're making more money or you can afford like an annual payment or something like that, you should still keep your original card open and do 1 or 2 transactions on it per year just to sort of keep that credit file active, so that if a bank or any other institution that does look at your credit score wants to look back and check if you've made all your payments on time or if you've sort of maintained financial responsibility with your debt, they will also have access to this card that has not been canceled. So even if you're someone who doesn't really believe in credit, doesn't believe in debt, doesn't want to spend money they don't have, or doesn't want to spend on a credit card, period, which I wouldn't recommend. I made a whole video on why I try to spend as much as I can on my credit card. Well, get a credit card and do 1 or 2 transactions on it per year, pay off the balance right away, use it like a debit card, and then you're done. And then you're slowly building up your credit score without giving way to that temptation of, possibly overspending because you can spend money that you essentially don't have. So the next thing is new credit, and this counts for just 10%. So essentially what this sort of envelops is, well, if you're trying to get a mortgage or get a line of credit, a bank will do what's called a hard inquiry or hard check. There's a few different terms that you can use, and they will go and request your credit file and apply for you will be applying for a credit product and they will check your credit score. And if you do a lot of these sort of hard credit checks, this will negatively impact your score. Now, we're not talking about 50 or 100 points, but it could go like 5, 10, 15. There's no fixed amount because the formulas that the FICO uses are proprietary, so they don't tell the consumers what the formula is. They keep that to themselves, and every different agency has a slightly different formula. It works kind of in the same way, but they're all slightly different. So if you apply for many products all at the same time, well, this will ding your credit score negatively. So if you want a car loan, you want a mortgage, and you want a line of credit and a credit card, and you're applying all within a 3-month period, it will definitely impact your credit score. And the institutions where you're applying to last will see, oh my God, well, you just applied for a car loan, you just got a line of credit, and now you want a credit card from me. Well, you're going to be seen as a much more risky person or a risky candidate because you just got all these new credit products and you weren't able to build up that history proving to them that you're able to pay them on time. So if you're on the verge of getting approved for something, so if your credit score is 700 and you need 690 to get approved, well, now would not be the right time to start trying to get all these other credit products. Get approved for that important one first, and then go ahead and apply for that car loan or apply for that line of credit. And then there's also what you call the soft inquiry. And this is if, well, I want to know what my credit score is and I'm going to just go online and check my credit score. That's okay. That doesn't affect your credit score. All that does is it just displays whatever you have on file. So it's different from a hard check, which a bank does. It's just you trying to see what your score is or look over your report to see if there's anything that's faulty on it, because it does happen sometimes that companies like Equifax or TransUnion would put negative things on your credit file by mistake. So it's a good idea to actually check your credit score just to make sure that everything's on par. So the last section of the FICO score, which counts for 10%, is the mix of trade lines. So there were, trade lines are what they use to call the different debt instruments that you can have. And they just want to see, okay, well, this person has a credit card, a line of credit, and a mortgage, and a car loan, and they're paying all of them on time, so they have a diversified range of credit products, and they're responsible with all of them. So they see that more favorably than just saying, oh, this person has 6 different credit cards. Yes, they're paying them all on time, and they never missed a payment, but they're only using credit cards. So maybe if they had a car loan, things would be different. In my opinion, it's kind of weird that they would put like too much weight, which they don't. They just put 10%. But it's funny that they actually include this, because paying debt is paying debt, or paying your bills is paying your bills. I don't see how the difference between a car loan and a credit card and a line of credit actually changes the way that you pay the bills. Yes, a line of credit, depending on what you have, you can only pay the interest. A car loan or a mortgage, you have to pay interest and principal in most cases. But other than that, I don't see why they would really focus on this very much. So now finally we get to the companies that will actually give you a credit score, but also track your credit file and give you a credit report. So there's Experian, there's TransUnion, and there's Equifax. And all these 3 companies, they do offer their own slightly different credit scoring methodologies or formulas, but essentially they all come out to the same thing. So if you miss a payment, it will ding your credit score. If you cancel a very early credit product and you don't have a new one to sort of fill in that historical gap, then it will also sort of not necessarily ding your credit score, but it will make it less interesting for the banks, and they will also be able to see all of your different credit files on the report. Now, all of these agents do give you a credit score. It's slightly different from the FICO score, but all the logic behind them are the same. So if you miss a payment on your credit card or on a bill, it will negatively impact your credit score. So if you cancel a credit card that you've had for a long time and you don't have any other products that can sort of support your historical credit worthiness, this will also negatively impact your credit score, and so on and so forth. So every different company or different institution has their own way of calculating the credit score, their own formula, let's say, but they're all, going to result to the same thing. And also the way that they can actually offer a credit report with balances is that different companies, like if you have a car loan or if you have a line of credit, they will actually report the balances to these companies, and they will be able to sort of put that in your credit file. So I remember when I was applying for mortgages, my mortgage broker would ask me, can you pay off the balances on your credit card, just because it'll make your credit file look better when they go through the report and say, okay, he has 2,000 owing here, 1,000 owing there. Okay, he paid them off, perfect, so he's able to pay off, so he's not in a financially precarious situation. And that sort of request can only come if they have access to the whole credit file. So when you apply for a mortgage, a very serious credit product, because we're talking about hundreds of thousands of dollars, they won't just look at a FICO score. They want to go through the whole report and see if you've been negligent in the past and if there are some balances that they would want you to pay off, just for them to feel more comfortable. So that's it for this video, guys. Thanks for tuning in. I hope you learned something on credit scores. It's a very important tool to understand and to sort of think about when it comes to applying for different credit products, and when it comes to planning for the future. Because if you want to buy a home in 2 years and your credit score isn't the best, well, maybe now would be a good time to start sort of focusing on paying your bills on time and try to maintain a longer term credit history, so not canceling any older credit products, just to be able to increase your credit score to the point where you can either actually get the mortgage or get a favorable rate on the mortgage. Again, thanks for tuning in, and I'll see you in the next one.